These are the top 10 mistakes I see in day trading all the time. Let's get in. Mistake number 1 is the lack of a trading plan. As you see here on screen, I've got a basic trading plan that everyone should stick to. This isn't the exact one you need because this might not agree with your trading plan. However, something this simple will change your trading. I've got 5 different tasks I need to complete before I enter my trade. Number 1 is the strategy rules. Which markets, what time of day to trade, the entry rules, take profit rules and the stop loss rules. Those have to be made before I enter the trade. Now, my risk control is my minimum reward to risk ratio, which I normally stick to 1 to 2 risk to reward. My percent of account risk per trade, and that's normally between 1 and 3%. And lastly, is my max drawdown allowance. That's how much drawdown I'm allowed for the day. Thirdly, my execution. What broker am I going to be using? What platform and what screen layout? Fourth, the routine. Pre and post game ritual, if you've got something like that. What do you prepare at the start of a trading day? Do you have your notebook ready? Have you got any notepads to stick to your computer screen to keep you accountable? And what's your review and journal routine? Like I spoke about in the last episode, everybody needs a journal to write down their trades. Lastly, skills growth. Analyze your journal to answer this. This is how much you've grown in the past few months, weeks, days, year. How can I increase my win sizes? As in, what can I do to increase my risk to reward ratio so my wins get better over time? This takes a while to get used to, so don't start filling this out straight away. The third one is how can I reduce my loss sizes? How can I tighten my stop loss so when I do take a loss, it's not too bad on the bank account? And lastly, what types of trades am I better at? This is what I spoke about in the last episode about journaling. I can't trade after 4 o'clock, so those trades are automatically withdrawn. Then you've got into, am I in a downtrend, uptrend, is the market stagnant? Those different types of trades you need to look at what you're best at so that you can only trade on those trades so that your ROI, your return of investment, is as high as it can be. Lastly, at the top you can see your trading plan. You can write your name, trading plan, whatever you want. And under that I've got a little motivational sentence just to keep me going for the day. Secondly, overtrading. I'm pretty sure you all know what this is. Let's go back to the charts. Now, this is what overtrading could look like. It depends on person to person. If you're scalping, your chart will probably look like this. However, if you're doing longer term trades, you wouldn't want this many trades on your chart. Now, as you can see here, overtrading in this example means trying to catch an uptrend even though the trade is in a downtrend. Every time the market goes to make a lower low, this person here is thought the lower low is indicating a reversal pattern. So they've tried to catch a reversal every time the market's made a lower low. Number 3, ignoring risk management. If we zoom back a bit, you can see what I mean by this. Here I've placed 5 trades, 3 losers and 2 winners. As you can see here, with a 1-to-1 risk management, your only profit is going to be 1% after those 5 trades are done. Whereas if you tighten your stop loss and make your take profit a bit larger, you can increase that to a 1 to 2 risk to reward ratio, meaning with correct risk management, you can have netted a 4% gain on your account. Now, risk management isn't just having a 1-to-1 or a 1 to 2 or 1 to 4 risk to reward ratio. It's realizing when you're taking too much risk, as in having too wide of a stop loss or too large of a take profit. Your trade's going to be in there for longer, exposing you to more risk. Number 4, letting your emotions take over. Now, trading emotionally can be brought back to the first chart I showed you. If we go back to that, this could be an easy example of letting your emotions get to your trades. If you look here, these trades are very obvious that someone wanted to go long in a bear market. So their emotion wanted to go long, even though it was in a bear market, their emotion clouded their judgment so that they couldn't see that this was a bear market, that they're losing out on all this profit they could be making if they just switch their trades around. Number 5, failing to adapt to a moving market. Why isn't Lewis Hamilton one of the best racing car drivers in F1 racing in rallycross? It's simple, different strategies. Lewis Hamilton is good in a car that turns around corners on its own and sticks to the pavement, whereas rally car drivers are good at flying their cars and swinging around corners with little to no traction. That's the same thing you've got to adapt to the markets. The markets might be stagnant, they may be in a downtrend, or they might be an uptrend. They might be reversing, they might be continuing their trend. These are all different market adaptations that you've got to make to your trading style. One strategy you have can't be better than the rest, as that will draw down the rest of your trades, meaning that just because that one strategy might be an 80% winning strategy, the other trades you have are only a 20% winning strategy, meaning your average is about 40 to 60%, not the best. Number 6, chasing the market. Once again, that's the same thing I've got on this page here. Chasing the market could be detrimental for your trading account. You shouldn't ever chase the market. If you see a downtrend happening, You should place a trade where you think it should be best and use that one trade for that one market. Don't keep following it down, trying to keep getting more and more profits, because it's going to bite you in the backside soon and you won't be too fond of it. Number 7, over leveraging. This is a big mistake I see happening all the time, and I spoke about it on a previous episode. Leverage can be good or bad. However, over leveraging can be detrimental for your account by losing just one trade. If you have small leverage, then you can deal with a few losses. However, with a big leveraged account, 1 to 100, 1 to 500 leverage I've seen before, this would ruin your account in 1 to 2 losing trades, and you can't afford that when you're trying to learn the basics of trading. Number 8, I think we've all seen this one before, it's too many indicators. What do you see wrong with this chart here? Can you even see anything? That's the problem. I can barely see where the candles are. There's too many indicators all saying different things at the same time. This is very confusing. Just because you can see some green arrows saying enter long on yellow crossing into EMA channel, it doesn't mean it's correct. And even then, if it is correct, other indicators might be telling you that it might be incorrect. You're just going to be left with a bunch of confusion, and realistically you won't be learning anything from it because you're just following some simple instructions that don't work. Take a look at my chart, for example. I've got 1, maybe 2 indicators on, and the second indicator is only for confirmation. Let's take a look. If we get rid of these drawings here, you can see exactly what I mean. This is what my chart normally looks like. I've got 1 indicator, and that's a smooth moving average at a level of 50. I'll bring up the settings now so you can see exactly what they are. Take a screenshot of this and save it. It's quite handy. So the length is on 50, because if I have it any more, I might lose out on some trades, and if I have it too short, it will be too close to determine the overall direction. The source I have it on is closed, because all I really care about is what the candle closed at. Anything else is just noise. And the time frame, I always have it on the chart, purely because if I change time frames, I don't want to accidentally forget to change the moving average and leave it at the wrong time frame. Now you can see here, the moving average does not take up a lot of room on my chart. If anything, it confirms to me that I've got a trend in the right direction that I'm thinking of, and that's all it is there for. The second one I use is the RSI for some divergences, which I'll get onto a different topic in a different episode. But I use that as a confirmation. I only have 1 indicator for confirmation and 1 indicator to tell me the overall direction that, to be honest with you, I already know. I just use it to see how far or how close to the moving average the price currently is. Number 9 is one that goes unhidden in a lot of people's trading journey, is the transaction costs. A lot of people miss the transaction costs. Now in brokers, some of them have very high transaction costs like spreads and commission, and others don't have such high transaction costs. Now normally, the biggest problem I see with this is traders make small scalping trades with small profits and they get eaten up by commissions and spreads, and you don't want that for your account. And lastly, the biggest problem, as you probably guessed it by now, the 10th biggest issue and biggest mistake I see is not journaling your trades. This is the biggest mistake because you can't look back on what you've missed and what you're improving on. I spoke about it in a whole separate episode for a reason. Journaling your trade is probably the biggest thing you can do to improve your trading. So if you're doing any of these 10 things, you should cut it out. And if you're not, well done. You're in the top 10% of traders as it is. Even if you may not be profitable, you're well on your way to doing so. So I congratulate you. So thanks again for watching this video. And as always, I'll see you tomorrow.